CA Rajesh Kumar sir. So he would be handling the wherever there are issues on litigation. I would request sir to intervene and add value to us. Ashika is not joining with us today, but we will be continuing the session. All right. The session I have divided into 3 aspects. First and foremost, to understand the definitions of the taxation given under the GST. Today, GST and RERA Act both have been linked. More so, the definitions under GST have been borrowed. Whenever we are looking at the taxation aspect under real estate, which is applicable is we have to see it in detail. So we will be covering the basics of the taxation. Then we look at the carpet area computation and the change in use. Then the other aspects of TDR FSI calculation, ITC reversal, and question and answers. This is how we have structured, and we should be completing our session around 5 o'clock. So let's start with understanding the rates of taxes in this segment. Though most of you are aware, let us just have a quick look at the entries that are there. First and foremost, we will be looking at the serial number 3 in notification 11/2017. That is the entry, the HSN 9954, where the commercial real estate or a residential real estate. And most of our discussions we are having around the apartment construction and development. In fact, in the last session, we have seen the plotted area development. So now let us understand in an apartment construction how the taxability of commercial and residential happen. To start with, the projects have been divided into multiple categories. RREP, which is residential real estate project. Then there is an REP, every real estate project. Then we have the rate of tax earlier regime. So there is a regime prior to April 2019 and a regime after April 2019. However, the prior to April 2019 have been given 2 choices. Option 1, they can continue under the old regime. Option 2, they can opt into new regime. The serial number 3 has addressed all these taxation structures. And the rate of tax which I have given at the bottom below is whether when we say 1%, 5%, please note this is an effective rate of tax and not original rate of tax, because we have a deduction towards land as 1/3. So the taxability is applicable only on the 2/3, which is deemed as the construction activity. So just to quickly look at, in an affordable project, which is earlier PMAY scheme, but now the affordable project is the 60 square meter or 90 square meter. If it is metro city 60, other than metro 90 square meters, and the consideration less than 45 lakhs is deemed as an affordable housing, which can attract 1% rate of tax. All residential projects other than affordable housing will be treated at 5%. Then there is a commercial aspect in an RREP. So that is the main topic for discussion today, is the commercial aspect in either in RREP or in REP. So the commercial aspect is at 5% if it is in RREP. Now in a real estate project, again, whether affordable, other than affordable, it is 1% and 5%. Older projects will continue the rate of tax 8 and 12. These are effective rate of tax. Now, most of people get confused between effective and original rate of tax. If I have to simplify and say an affordable project, when we are saying 1% without ITC, the way it is derived is 1/3 is given as a land deduction. The effective rate of tax is 1.5%, 0.75 CGST, 0.75 SGST. So the 1.5% into 2/3 would be 1%. In case of a other than affordable, we say 7.5% is the rate of tax. 3.75 plus 3.75 into 2/3 would be resulting to 5%. And a commercial, purely commercial projects is 12% with input tax credit. The residential is without input tax credit. Commercial is with input tax credit. Effective rate is 12%. How? 18 into 2/3. Now, when the work is given to a subcontractor, when a subcontractor is handling or executing the projects, the rate of tax for him is generally 18%. But the affordable housing sector, since the rate is to be lower, the affordable housing sector, the rate of tax is to made to 12%. This is broadly the rates of taxes for an apartment construction. And feel free to put your questions in the chat. At the end, definitely we will also have a Q&A session. You can unmute and ask your question. We will take up the questions in the chat as and when that comes. Now, the discussion for today is if the projects are mixed. That is, if there is a commercial project, there is a residential project, and other than residential project. Sorry. Yeah. So there is a commercial project, point 2 a residential, point 3 residential other than affordable. Now we have seen the tax rates given in the law 1, 2, 3. We have seen the tax rates. The tax rates for discussion today is when there is a mixed project. What is a mixed project? Which means in an apartment construction, some portion is commercial, some portion is residential, some portion is affordable and other than affordable. So that is further split into two categories, where the portion of commercial is less than 15% of the total construction. Situation 2, the commercial portion is more than 15% of the total construction. So the tax structure differs for both categories. There is a difference in the tax structure. Now, where the commercial aspect is more than 15%, it is an REP, a real estate project. So the project has affordable, residential, residential other than affordable, and commercial. All three different categories of constructions are there. Let's assume that in single project, I have all these three different projects available. A rate of tax will be independent, which means to the affordable portion, I will be charging 1% on the total consideration. For a residential other than affordable, I'll be charging 5% on the total value. When it comes to the commercial portion, I would be charging 12%. The only thing you can see it is in green color, there is with input tax credit. This is what the tax to be applied in a single project. There are three different aspects and three different customers, three different tax rates. But there could be a situation where the component of commercial portion is less than 15% of the total construction. When I say less than 15% of the total construction, is the definition here is carpet area is what now we have to look at it. So if I have my commercial portion is less than 15%, then the affordable housing section continues the tax rate of 1%. The residential portion would continue the tax rate of 5%. Where the more importantly, the commercial portion, the earlier it was 18% or 12% effective with input tax credit. Now it would become 5% without input tax credit. So the key point here one has to be noting is what is the percentage of the commercial portion in the project. And when we say what is the percentage of the commercial portion, we are now looking at carpet area. So to qualify as a residential project, the maximum permitted commercial portion is 15% of the total carpet area. So of the total project, the commercial portion carpet area should be 15%. Now that is what one has to look at it. Now, how do we get this? Now, how do we derive it? So whenever you make an application for plan sanction, in the plan itself, you will have to necessarily bifurcate the total constructions that are happening. I've just given you a sample thing. So in the layout which you are doing, so here is one construction which is happening, where the residential portion has some 47,000 square meters, commercial portion has some 79,000 square meters. So if you see, 37% is commercial portion, residential portion, and 63% is the commercial portion. Now, this is how you will have to identify whether this is a project where the commercial or residential. Now, why is it very much necessary? Because from the taxation perspective, we all know any input tax credit on works contract is not eligible for the end user. When the input tax credit itself is not eligible, the higher the rate of tax, it will increase the cost. So to be advantageous and competitive, people would want to have it at a lower rate of tax. Now, to charge something which is a commercial, which was otherwise 12%, coming down to 5%, there should be a sufficient documentation. But however, the definition which is given in the Act is the carpet area. Now, we also need to understand what a carpet area is. So before I move to the carpet area, Rajesh sir, would you want to add anything at this point?
I think till now what we were actually looking at is the definition and the rate of tax part of it. But always from a business perspective and a practicality perspective, many a times this allocation of a commercial and the residential depends on the approval, as you rightly pointed out, and you have clearly brought out that approval aspect of it. I know that you are going to go deeper into it as to the other aspects of what happens if there is some area which is commonly used, which will be rented out by outsider, which will be held within the association, which is used as a clubhouse. So those aspects is what actually going to make a difference, if any, and the issues which may crop up during the litigation. And I think the people may also have a doubt on those aspects of it, I think, which we'll cover the later point. Until whatever you have covered, I am completely in agreement with whatever you have said, especially the approval given by the authority is going to be a much more authoritative evidence, which you can use it against any questions which will be raised by the authorities, and not otherwise of we can say, no, sir, there's no actually commercial, it's only record. We have actually converted residential, or the residential would have converted into commercial. So all those things may not matter, provided we have a sufficient evidence that it is actually as per the approved plan. And also, I think maybe Vinay may be adding what happens if I deviate from the approval plan and does something, which one will prevail? So I think that is where the expert from the RERA side pitch in and explain on that.
Right.
I think that's all from my side.
Got it, sir. So now let us understand the basic definition of carpet area. Of course, I am not an expert on RERA, but the definition of carpet area under GST is, it says the carpet area, whatever which is defined in 2 subsection K of the RERD Act. Now, when I go to RERD Act, the definition of carpet area is, it says net usable floor area of an apartment. And the definition of apartment is anything, even a single room is also an apartment. So it is a very widely defined thing. So in an enclosed area, in an enclosed construction, the carpet area has to be construed. Now, what they say is the net usable floor area of an apartment is something which is excluding the area that is covered by external walls or service shafts, or an exclusive balcony or veranda area, or an exclusive open terrace area. But it includes the area covered by the internal portion walls of the apartment. So technically, it is if excluding the internal walls, between the boundaries between the four walls would be the carpet area. And for the purpose of this clause, they have also said the exclusive balcony or veranda area means the area of the balcony or veranda which is net usable to that respective floor area of an apartment, which is given to the LOT. So that is how we will be looking at carpet area. In fact, in the RERA applications that we make, the sale agreement and the sale deed, the samples also needs to be approved, where one has to now start defining the sale proceeds linking to the carpet area. Prior to the RERA, there was a practice of super built up area or a built up area, or on the different ways of putting the rate. The rate per square feet or rate per square meters is now has to be determined basis the carpet area that is being sold. So that being the case, it is the documents that we are submitting to the authorities would be the basis for the purpose of determining the carpet area. Now the question that comes, now if you look at it here, the carpet areas which I have said is excluding the area covered by the external walls. So which means the area inside the four boundaries is what the carpet area. Now the point for us under discussion here is how much is residential and how much is commercial. That is what we would like to bifurcate. The common question people might have or that would come up is, in a big high-rise apartments, there is a common area which is used by the tenants, but it is not a residential area or it is not a residential purpose. For example, your gym, library, clubhouse, the security room, or you have a temple premises. Sometimes you have guest rooms or reading rooms, or there is a lobby area where the watchman security is there. Now, is this a residential area? The answer is no. Is it a commercial area? I don't have a definitive yes answer, but I could say that this is not a residential area. Okay. Now let us look at the another set of common area. So the first one is also not sold to anyone. The second common area, even this is not sold to anyone. This is actually rented for the commercial activities. So some portion of the high-rise apartment. So let's look at exclusively very big apartment where there would be some small portion which would be given for the either it could be a eatery outlet or a clinic, or it is a small, you would today we have this from the big basket or anyone a self-vending machines where a small place is allotted to them where the association is earning the rental incomes. Now there is again that is a common area which has not been sold. Now there is an area which has been sold. So the rest of the area which is sold is the individual apartments and the commercial complex spaces. Now that is clearly identifiable for the purpose of defining 15%, because tomorrow you will get into a litigation wherein the officer would want you to prove that okay, which is when the moment commercial portion is less than 15%, the rate of tax you are charging is only 5% as against the 12%. So how do you prove? The basis would go back is the original plan sanction. Now, what happens to these areas which have not been sold and which are not residential? So I was actually discussing for the purpose of this session with a couple of lawyers and also with Vinay and other the experts. I'm sure most of you are aware, while you are making the registration of an apartment, assuming I have taken an apartment, 2,500 square feet an apartment, say 3 BHK, but my carpet area would be around only some 1,500, 1,600. What happened to the rest of the area? While I am making the registration with the sub-registrar, I am paying the stamp duty basis 2,500 square feet as the basis. However, the carpet area which is given to me is only say 1,600. In fact, in a project, the entire square feet of the project is allocated between all the tenants. So even this super built up area, which I am seeing as gym, library, security room, lobby area, all that is been allocated and sold to the tenants for their use. Even though it is not a residential area, for the purpose of your computation, all that you would be looking at is the carpet area which is given to the tenants, carpet area which is sold as commercial. Now, when I sum up the carpet areas, it will definitely not match to the whole of the area because there is a common area. So you would have to go by, if I have to go back to my previous example, you would have to go by with the plan sanction which has been given. However, this there is an FAR and super built up, and maybe another 15% the lower to this would be the carpet area. So you would need to prepare a document which will clearly establish what is the percentage of a commercial portion and a residential portion in a project. So this is the one which would be determining the rate of tax between 5% without ITC or 12% with input tax credit. So I would like to give a pause at this point before I move to the next topic. I would see if there are any questions or anything to be added by either Vinay on RERA or on the Rajesh sir on the aspects which we discussed.
Yeah, I think Venu, the one point I want to just minutely explain in your previous slide. You can just go back to previous slide. See, this unsold, when we use it, it is saleable. Unsold is a one possibility, and it is not saleable because it is a part of the common utilities are to be understood very carefully, because the developer has a right, sometimes in the agreement, etc. The developer will be the owner of the clubhouse that will be managed and run by them. So in such a scenario, in my view, maybe subject to Vinay's clarification, would be counted as a area, whether commercial or residential, in the approval plan, but the ownership may be retained by the developer. In such a scenario, may be a little different outlook we need to look at from this perspective or explanation, what you said. Two, second, there something which is belonging to everybody, ownership title is belonging to everybody and is transferred to the owners association form as per the Apartment Owners Association Act or whatever it is. So in such a scenario, maybe the discussion what we made will be more apt, is what I wanted to just emphasize. I think Vinay, you want to add something, or Vinay will ask Vinay to add something?
I'm not sure Vinay is there yet.
He was here.
Okay, so the couple of points which
Vinay is there.
Okay.
Vinay?
Okay, maybe I think he's away. Yeah, a couple of points when I discussed with Vinay on this aspect. So one thing which has become clear is.
You want me to talk on this, Venu? Sorry to interrupt.
Yes. So all this common area have to be relinquished by the promoter in favor of association. So the ownership would also be going off to the association after the RERA. But yeah, Vinay, I would like you to add.
Okay. Hi. Good afternoon to everybody. Thanks for calling me and requesting to share some of my knowledge. So basically, post RERA, what is required to be registered or conveyed to the customers or allottees in the project is only the carpet area. I hope you have shown what is the definition of a carpet area. Section 2K of the RERA talks about carpet area. Apart from the carpet area, whatever is there is called common area. Common area defined under section 2N. So carpet area is the portion which you live inside your apartment is called carpet area. Anything apart from that is called common area in a project. All this common area is and with the custody of the association of allottees. That basically we call it as apartment association owners, resident welfare association owners. So these all common areas would be in the hands of the association. Mean to say that your super built up area or a built up area minus carpet area is called a common area, and this common area is in the hands of the association. And basically there is this will not, it is not called relinquishment. Relinquishment is a separate word itself. At the time of taking the plan, some of the road or the park would be relinquished to the planning authorities. This is not a relinquishment. Section 17 of the RERA mandates all these common areas to be handed over to the association of allottees. So that is the difference between common area, carpet area, and the super built up area. And finally, in case of a mixed development project, the builder, the promoter should really bifurcate and segregate properly, appropriately what is belongs to the commercial aspects of the projects and the residential aspects of the project. The simple reason is, if you do not segregate, then the entire commercial area also gets the gets under the hands of the residential area also. For the simple reason, it would be a single plan sanction. Now we have shown some sanction plan, right? Venu, we have shown sanction plan. In the sanction plan, if you see, it's a single sanction plan where one side you have a residential, another side you have a commercial, and by virtue of that, customer get a right in the entire project, entire 14 acres, 31 guntas. If you see, this project is a 14 acres, 31 gunta area. In entire 14 guntas, 14 acre, 31 gunta is what he is eligible for a UDS, undivided share in the land. So it's very important in terms of the legal aspects to be considered. Apart from the GST, one to think of how do we conceive the project, how do we build the project in a most complied way. And also it is a very common practice that where there is a commercial area, land, FAR generally would be loaded to the residential area for the purpose of, for the sake of restricted FAR are permitted. So that is also to be considered for the purpose of planning the scheme of project. Any other specific questions? Let me know.
I think
Okay.
one.
Yeah.
Vinay, I do have two questions for you.
Yeah, please.
Question number one is, say my approval plan in whatever is said, residential is so much, commercial is so much, what was originally sanctioned to me.
Yeah.
So I'm a decent developer, I will follow it. I'm an indecent developer, I will, the residential portion I can make it a commercial and sell it as a commercial. So, though the approval plan is, for Venu purposes, commercial area is less than 15%, but actual measurement goes, it is more than 15%. In such a scenario, what is the rights and privileges of the your sanctioning authorities is what I want to just know. Question number one. I'll ask question number two later.
Okay, so basically what you're trying to say, deviation from the plan sanctioned from the planning authority, where they have sanctioned the plan as a residential plus commercial. Commercial is less than 15%. However, I violated and made 40% as commercial or 50% as commercial. Sir, it is only the advice of the chartered accountants to avoid the GST, sir. Okay. Do not advise them, sir, yaro barala, nobody will come and see you. So you increase the commercial building area so that you can avoid the GST. Please do not do that, sir, because if at all, if that is called as a real estate project, which is comes under RERA, then they will have a bigger challenges, because section 14 of RERA requires the approval of the allotee and the authority when there is a change in the plan. It's basically a modification of plan. And if in case residential, if they wanted to intend to use as a commercial, then section 14 applies. That's a violation, sir. So, sir, you are on mute, sir. Rajesh, sir, you are on mute.
I think, no, my voice is getting routed to Venu's voice, so no problem.
Okay.
In fact, why I raised that question is, like, income tax, they say, illegal income is also income subject matter of a tax.
Yes, sir.
Clearly, here, the fact is that if the actual construction is more than that particular thing, it's always possible for the authority to take a stand that merely by the fact that the approval is for 15%, but actually, factually, it is more than 15%. Therefore, you are ineligible for the benefit of that 5% scheme. So, you are liable for 18% of the entire commercial will be the proposition, which I think court also would want to approve. And further, if the action is initiated by the authorities, they will also confirm that we'll have a weightage to that. This is the first.
Yes, sir. True.
The next question I want to ask.
Sir, I would like to add a point here.
Yes.
See, the change in use.
That's the next question.
No, it's like, see, I have constructed it as a residential, but the buyer has converted it as commercial. I did not sell it as commercial. So my plan was less than 15%. I have sold it as a residential, but he is using it as commercial. Now, for me, I would still hold the rate of tax, that 5% which I have applied should hold a good. What do you say, sir?
No, I think, yeah, your point is correct, but all it becomes on the facts. What was marketed and sold at that point, was it residential and is a violation by the user or it's a violation by the supplier? So that is the only point. And the only quickly, Vinay, the last question to you. What happens if there's a change of plan before OC? Well, they will modify that plan and give a revised plan.
Then that amounted to plan sanction. If there is a change in modification of a plan, then if that fit into 15% or above 15%, accordingly it holds good, sir.
No, your authority will change, correct?
Yes, sir. Yes, yes, true. That is called modification of plan. Always that is there, sir. Building bylaws permits it, sir. Yeah. Thank you, sir. Thanks for the opportunity and continue. All the best.
Thank you. So for the participants, I would like to add a point here is if there is a change in plan, in the sense the plan sanction itself, there is a change in the plan. So when there was a change happened in the plan sanction and the percentage of the commercial originally when I started was less than 15%. Later, there were separate permissions have come. Owing to these additional permissions, my percentage of the commercial portion has gone up. What would be the position of the tax authorities? So I'd like to hear the answer from Rajesh sir on this point.
Yeah. I think a very interesting question because there will be two aspects. In fact, the valuation and rate of tax. What is the date of value and the rate of tax which we need to adopt for the purpose of computation of a tax? In my understanding, is the time of supply. Whatever was prevailing on the date of, the time of supply, to the extent of the time of supply, cannot alter the position which is going to happen at a later point in time. So on the time of supply, if my proposition was of a certain nature and I have accordingly applied the taxes correctly, if there's any change at a later point in time, the change impact should happen only for the subsequent installments which may come in. is what is my view on that point. But obviously, the next question which is going to come is what happens between the buyer vis-a-vis a developer. That is a purely a contractual obligation, whether who has to bear the incidence of that increased tax, if any. If the agreements are not clear, then I think it is going to lead to unnecessary dispute and may lead to arbitration between the parties. So this is what I want to ask.
Yeah, sir, I would like to have put some more awkward question and ask here is, let us hypothetically, when I started the projects, let's say I have 2 units as commercial, and my plan sanction was permitting me to construct commercial only so much, which is less than 15%. The first unit got sold at the time of selling. Since it is less than 15%, I have treated as also an RREP and sold it at 5%. Since this being a continuous supply of service, the supply happens from the date of my agreement until the OC. So the supply is continuously happening. Do you say even the first, and let us say during the course before the second unit is sold, I got a permission to have more commercial space. The commercial area went up beyond 15%. Now, would you say, or it could also be another situation, I am unable to achieve the FAR in the residential portion. The residential portion has come down for various reasons. So could be there's a granite or could be a road cutting, whatever, I don't know. My percentage of the commercial portion has come down. Now, after that, my commercial percentage crossed 15%. After that, I'm selling the second unit. It is obvious, I am thinking it is obvious the second unit would be taxed at original rate of tax, which is 18% or effective 12%. Now, this first unit which got sold at 5%, some installment already fell due, which I have already collected at 5%. The installments which are going to become due subsequently, would the original time of supply would apply, or I should be taking at that time a revised time of supply and charge 12%?
See, time of supply is not linked to what is going to happen. Time of supply is dependent upon your when the amount has become due. As in your question, what you asked was that it has become due on some of them has not become due. If in a continuous supply something has not become due, the time of supply has not occurred. I would like to take an example. Suddenly, if the government comes out today and increases the rate of tax from whatever the concession rate of 5% to say 8%, wouldn't be charging that particular apartment from 5% to increased rate of 8%. The same would be a position here also, because your classification, the entry which you are falling in has got changed from the 5% to 12%. So this is what is my take on that. On that particular.
Got it. Yeah, thank you. So friends, if you have any questions, please put your question in the chat. And let's move to the next topic, which is on the TDR exemption. Since there is a commercial and the residential involved, how this needs to be computed. Given that we have already had a discussion on TDR, this is going to be a pretty simple discussion. First and foremost, we know that the development rights which have been given by the landowner to the promoter in a project, there is a blanket exemption and the reverse charge. However, the exemption is restricted to the residential. So the notification 12/2017 entry 41A, which gives an exemption for a promoter. Now, why did I use the promoter? Because under GST, landowner is also treated as a promoter. So we treat landowner as landowner promoter, developer as builder promoter. So there could be a situation where landowner is transferring to the promoter, or the project is getting a halt and builder promoter is selling off his rights to someone else, another thing. It could be any. So any promoter who is transferring TDR for construction of residential apartments is covered under the exemption. So please note, TDR for the residential only is exempt, not the commercial. The exemption methodology which is given is compute the GST on the total, the TDR, multiply it with the carpet area of the residential apartment divided by total carpet area, that is residential and commercial apartments in the project. Only that much is given as exemption. This is in the hands of the developer, who is called as landowner. So landowner promoter gets the exemption. The builder promoter has to pay tax. Now, where does that say? The taxation comes as a reverse charge. In the notification 5/2019, where 93 got amended. So any supply of service by way of development rate, whether commercial or residential, both the liability to pay tax has been shifted to builder, which is developer promoter. So landowner promoter will not be paying tax, whether commercial or residential. Residential is exempt. Now, the residential which is exempt has to be borne by the developer promoter, builder. How? Basis the carpet area of the residential units which got been sold and unsold as on the date of OC. So this is further restricted to whatever is the GST which is otherwise applicable on the unsold units. So as if it has been sold, whatever be the tax liability. So this is what it is further restricted to. So whatever is the GST which is computed for the residential apartments is multiplied by between the carpet area of the units unsold by total carpet area. This is on the development rights taxation. Though the formula apply, when you read the notification and formula, it appears to be complicated, but the conceptually it is pretty simply and beautifully drafted. The question that comes is input tax credit. The moment where the carpet area is increasing more than 15% for the commercial, we say input tax credit is available. But you may notice that when you buy steel, cement, iron, everything, you don't buy separately, or you don't get a bill, commercial portion separate bill and the residential portion separate bill. So how do we treat this? So again, the rule 42 has been amended, where they said that there is no question of the taxable exempted credits. In a common rule 42, when we see, we have this terminology T1, T2, T3, T4, C1, C2, D1, D2, all those complicated math, all that is gone off for in case of a real estate. They said whatever is being procured is to be treated as common. Segregate it each project wise. On the date of the occupancy certificate or completion certificate, you compute how much has to be reversed. The reversal is the total credit available into unsold divided by total. But however, I am now including residential. So the way you will have to do is, you find out the carpet area in each of the bucket. Let's say the total carpet area is 100. Residential carpet area is 60. Commercial carpet area is say 40. So the 60% portion input tax credit not allowed. Out of 40%, the carpet area, let's say sold before OC is 25%. Only that 25% sold before OC is eligible. The one which is sold after OC is not eligible. So it becomes very important for a developer that they have to track the carpet area unit wise, whatever the number of you. So total ITC segregate into project wise, each project segregate into unit wise. You can reverse during the months also. Not necessary that you have to do this on the date of OC, but necessarily the cutoff numbers, these percentages have to be computed on the date of OC. Friends, these are the various points that we have discussed, were due for discussion today. One is the taxation of a mixed project, residential and commercial, and When there is a commercial, how do we tax the development rights and give the exemption? And how do we carve out the input tax credit, which is there common for this? So with this note, we have come to end of today's discussion. We have any questions, we can take up the questions. And before the question, Rajesh sir, anything to add?
No, I think when on the credit side of it, why is that they are treating all credit as common? The rationale behind that is because at the date of construction, you do not know how much of that is going to get sold, how much of that is not going to get sold. One, two, also the fact that there's certain portion of uncertainty as to whether it will be sold at all. So considering that particular fact, they did not find any other mechanism where they could say that clearly that this is what is towards taxable. So they consider everything is based on an average basis, formula basis, based on the carpet area. You may actually try to say, no, sir, I am having a portion of it as a commercial clearly. So I will identify the credit clearly for that and take it. I think they don't permit that. Yeah. On the other hand, the department cannot come out and say, in commercial area, you have just put 4 pillars and sold it to them, whereas substantial materials are used for residential. So I will not allow that credit which is exclusively used. So they should also not go for it. Essentially, if you see, Rule 42 is based on the aspect of averages, where either government may lose out something or the assessee may lose out something, where once we are falling into the clutches of Rule 42, within that 42, I cannot still again segregate subject to the provisions. I will go for portion of it, I'll go for actuals, portion of it, I'll go for Rule 42, except some of the scenarios which is specifically permitted in the Rule 42. This I thought I'll just share. One more aspect, you did mention about the tax liability on a development right, which is to be paid on RCM basis by the developer. There, I find practically how to determine the valuation for it is unresolved issue, though there may be a differing aspects which may be coming in, but practically when you really sit on your desk trying to compute it, the explanation given in notification 12 also will not help you to correctly determine, because it says what is that value which you need to adopt. Again, we fall short of the clarity even in that aspect of it. So that's a gray area which one has to keep in mind while determining this allocation of the tax to be paid on RCM basis, especially in this mixed supply concept of it. That is from my side.
Great. Yeah. Got it.
Questions?
Thank you, sir. So participants, any questions for the discussion? Now the floor is open. You can ask the question. We have some more time, madam.
Yes, sir. We have another 5-10 minutes. So definitely participants can ask the question.
Yeah. I just saw the chat was not enabled. Maybe now you can put your questions in the chat also.
Participants, I request you, if you have any questions, you can ask me. Yes, sir. There's one question that have come with by CA Swapnil Jain. He's asking how to do the 2B reconciliation. 2B will have all ITC for mixed projects.
Yeah,
Mr. Swapnil is asking.
Yeah, Swapnil sir, so this is the bigger challenge earlier. Before this notification, the question always used to be as, how do I reconcile? So I might have different invoice number in my books and different invoice number, different date of accounting, all those things. But after this notification, the second challenge is, I might be buying from, let's say, Vizag Steel. I am buying the steel, but I have to segregate that input tax credit even before I do reconciliation. how much is, which bill is to project A, which bill is to project B. So I have to do that segregation. Let's say project A has in one invoice, I have consumed only out of say 30,000 metric tons which I have purchased, 10,000 has gone to project A, 20,000 has gone to project B. You know, all those things would be there. So you will have to necessarily do a project wise accounting along with the reconciliation. So you will have to segregate it a project wise. After segregating, don't worry on the mixed project, because the project is everything is common credit. Everything you treat as if it is eligible to you. At the end of the OC, remove that portion which is not eligible. What is not eligible? Commercial, unsold, all residential, whether sold or not, is ineligible. So in that ratio, you take it.
And so we have another question by Mr. Hirav Shah. He's asking, at the time of filing of GST return, what rate should be mentioned, like net rate or gross rate?
Okay, at the time of filing GST return, one again mistake which I have commonly seen earlier, at least, where the 12%, 18% was there available in the drop down, people used to put the total value and put 12% as a rate of tax. Actually, that is wrong. What you have to put, there is a taxable value and the invoice value. If let's say invoice value is 100 rupees, what you have to report in GSTR1 is 67 rupees at 18%, not 100 at 12%, because both will give you the net answer as 12. But reporting 100 at 12 is wrong, because you cannot sell the land to the customer. The GST is not applicable. So it has to be 2/3 value and the gross rate.
Okay, okay, sir. And there is one more question. Question is from CA Nitesh. He's asking, what is the time of supply for payment of GST under RCM on TDR on commercial part?
Right. So the Niteshji, the time of supply thankfully has been given as till the date of OC. Now that definitely doesn't stop someone discharging the taxes at the earlier stage also. However, the upper limit, the notification 6/2019 has given me the time of supply can be determined till the OC date, because there is a barter that has happened. There is no real cash flow. The cash flow can actually happen when the units get sold or anything. To defer it, what if you have to see the original prior notification 4/2018? The similar provisions have been brought in 6/2019, where the time of supply has been deferred to the date of OC. However, if there is landowner who is getting some units, he is also selling those units, he wants to take the benefit of the taxation, etc. The builder developer can discharge the taxes earlier to it, because section 13 permits you to discharge the taxes earliest of it. The moment you raise an invoice, the time of supply would trigger in, but the last would be the last step.
Somebody is raising a hand.
Okay, Kishore would want to ask a question. You're raising the hand. Maybe I've prompted you to unmute. You can unmute yourself and ask, Kishore.
Yes, Sirji. If the tax on the development rights is paid at the time of completion certificate, the problem is that the rest of the shops are sold earlier, so we won't be able to claim the input tax credit. And that's why practically it has to be paid as and when the project starts. This is my view.
It can be, actually, Rajesh sir, yeah.
I think, Mr. Kishore, I would like to balance it, not to say that you should pay at the beginning of a project. In fact, practically what do happen is whenever that particular the sale of the landowner's share to happen, that is where they allocate. Whenever we are able to encash it, whenever the sale booking aspect happens correspondingly, that is when that particular RCM liabilities are discharged to enable that particular payment and availment of credit wherever required.
Yeah.
Why to pay everything and get blocked with the credits, that is what is the view taken. And again, it depends on where we are eligible to take credit, where we are not eligible to take credit. Based on we need to take a decision.
Okay, sir. Thank you.
And sir, there are the few questions actually from our YouTube channel also. One customer, Mr. Sairam, is asking that for shortfall in value of purchases below 80% of total purchases, how to compute the shortfall? Will it has to be considered as purchase of goods or purchase of services if shortfall has both?
Madam, actually, we had a session exclusively for this. Maybe
Mixed projects. Okay.
that session can be referred because it is little lengthier discussion as to how to compute, etc. So that can be referred.
Okay, sir. Mr. Sairam has put so many questions in the YouTube chat. No problem, sir.
Yes, I don't know because it's already put in the chat also something is coming. You can just see.
Yeah. Yes. In the chat also, he has put all those questions.
Yes, so that 80%, I would suggest I think it's there on the same link, madam, in the YouTube channel of ours.
Yes.
Yeah.
So sir, we have already the few previous sessions which has been done on this topic. So you can go to our YouTube channel, RERA Consultants LLP, and there you can watch the videos.
And any clarification, feel free to.
And for any clarifications, you can call us.
Sure.
Okay, sure.
Right.
So any other questions by the participants? Yes, definitely. For this session, if you have any queries, you can reach out to us. We will connect you with our speakers. And at last, I would like to say thanks to our speakers, Venu sir and Rajesh sir, for contributing their valuable time and expert opinion on the taxation of mixed projects. I hope that our participants, they have gained enough knowledge on this topic. And I would like to tell you at last that our next session is going to happen next week, that is on 23rd of March, on RERA year-end 2022 compliances. And we will share the details of our this next session with you by the next week only. Thank you all and have a great evening. Thank you, sir. Thank you, Rajesh sir. And thank you, Venu sir.
Thank you. Thank you, everybody.
Yeah.